Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. Joining you again this Thursday, August the 8th. The last time I was with you was actually a recording that we did after the close on Wednesday, and that was July 31st. That was the day the Fed came out with their announcement. And so all I had to work with at that time was just a couple of hours of trading after the Fed. Well, now we've had a full week beyond that Fed meeting. And I think things have seriously worsened since then. We did get a initial jobless claims report out last Thursday that was much higher than expected. And with the Fed finally announcing that, hey, we recognize that there's market weakness that's starting to build in our economy, or economic weakness, I should say. Obviously, there's market weakness. But the Fed did indicate that they saw economic weakness, but they weren't going to lower interest rates. They decided that we're going to keep rates just pat. We're going to wait until September, and then a possible rate decrease will be on the table. Not that it's coming, just that it will be on the table, and they were going to continue to look at data. Market has not liked that. And I'm not surprised. We had a pretty rough Thursday and Friday of last week, and then, of course, got a big gap down on Monday where we saw the Dow Jones down over 1,000 points. Since then, we've tried to work our way up. You've noticed there's been a lot of movement back and forth, and that's represented in the volatility index, which we'll take a little bit of a look at during the show. But that volatility index, anytime it climbs up into the 20s or beyond to the upside, I am generally going to just sit pat as far as my trading goes. There are a lot of folks that love that volatility and try to catch these big swings. For me, I think it's more of a crapshoot, 50-50, flip a coin. And I'm not putting my portfolio up on a coin flip or a one roll of the dice at the roulette table. I would much rather let things calm back down. Maybe place a trade here or there, but I'm just not somebody that likes all that volatility. Give me a boring market with the VIX down around 10, 11, 12, and I'll be perfectly content. I think that's a much, much easier and safer environment to trade. But anyway, got a lot of charts to show, so I want to go ahead and get started. Let's start off with the Dow Jones Industrial Average. So I'm going to go through, I want to show you some of the big picture 5-year charts on these major indices. And then I've got some charts that I think, aren't as obvious. A lot of people maybe aren't talking about that I think you need to know. So here on the Dow Jones, last 5 years, you can see obviously we've been in an uptrend. We had, yes, the pandemic in 2020. We had the cyclical bear market in 2022. We had a little bit of weakness correction at the end of last summer in 2023. And then earlier this year, we saw weakness back in April, and now we're seeing it again. Historically, if you are a historian like I am, you know that this time of the summer, late summer, tends to be the time when the market doesn't do so well. That's history. That's dating back. My study goes back to 1950, looking at every day's data on the S&P 500. So we are in the worst period of the year historically. So just keep that in mind. I always lower the bar of expectations when I'm looking at the market this time of year. Now, looking at the Dow, we've pulled back. This is a weekly chart, so these are weekly candles. So far, this week's candle, we really zoom in over here on the right-hand side of the chart, you can see we're trying to print a hammer right down at the 20-week moving average. So overall, not really bad action. We do still have a negative divergence in play on the weekly chart. And as a result, we can't rule out, and maybe we should expect, a 50-week test, which would put us down at about 37,500, somewhere in that neighborhood, which would be, well, we can look and see where that 50-day is, 37,472. So, and it's rising. So anything down around 37.5 or maybe a little above over the next couple weeks to a couple months would do the trick, would get us back down to that 50-week moving average. So keep that in mind on the Dow. Moving on to the S&P 500. The S&P, again, you can see the top that we took out from the beginning of 2022 over here. And then when we came back down in April, after we made that breakout above the top, the all-time highs, we had that April weakness. So I've annotated 2 different support levels that I'm really watching closely. And I've said, I think, we potentially could move down to 4,800, 5,000. I don't think that would be anything to break the bank as far as this longer term uptrend goes. But in this late summer, early fall period when we know the market can be a little rougher. I don't rule this out. I don't rule out going a little bit lower, possibly even taking out that April low, which would spook a lot of folks. But like the Dow Jones, we have a negative divergence here on the S&P. But unlike the Dow, I guess still similar to the Dow, we had a move intra-week that was down well below the 20-week moving average, but we've moved back up. We're trying to hold on to it with a hollow candle this week. We still have more trading to go, though. Again, these are weekly candles, so we got to finish out the day and then also negotiate tomorrow before these candles become final. Obviously, if we go up from here, that's going to be more bullish, perhaps finishing back above those 20-week moving averages. But if we were to reverse lower, move back down, I think it would be starting to look much, much more like we were going to head to this 4,800 to 5,000 level. All right, next up, we got the NASDAQ 100 on the weekly chart. Again, negative divergence is pretty apparent here. Higher prices, lower PPO. This has been going on for almost a year on the NASDAQ. And Monday's open, the big gap down, literally went down almost right to that 50-week moving average. So in this case, I think this negative divergence has already played out on the NASDAQ. So that's maybe a little good news. The bad news is obviously the NASDAQ isn't performing as well. And that's where a lot of our growth stocks are. That's where you're going to find the Mag 7. And so those are the areas that really represent a large portion of the S&P 500, which is what's going to hold the S&P 500 back unless these stocks start to regain a lot of strength. And they have off that Monday low. But let's see if we can continue it through the balance of the week. And we now have, 4 weeks in a row with lower lows and lower highs. We've got to end that streak at some point. So that's one thing we'd be looking for perhaps next week. All right. In a highly volatile market, this is where I want to show you a couple charts that I like to follow. Maybe it'll help you in your trading as you go along. When we get into these volatile markets, I try to find extremes. If I'm going to, put my toe in the water trading, I want to get to a point where I feel like we're at an extreme panic level, where we've been seeing so much selling and all of the retail traders try to move into equity puts. So that put call ratio, really starts to move out of whack and moves up actually into an area that normally signals that you are in a heavily panicked state in the market. So this is a 5-day moving average of the equity only put call ratio. That's the top panel that you see up here. The middle panel is the actual S&P 500, and then the bottom panel is the volatility index. Now, I have shaded in red all the times when we have seen the VIX up above 20, because that's just my trigger point. That's telling me that, fear is building up until you get to 20. When you get above it, it's really starting to intensify. And historically, I know the S&P 500 does not perform as well when we are moving into the 20s, 30s, and beyond on the VIX. So I'm keeping that in mind. You can see during the cyclical bear market from 2022 through October 2022, so it was about 9 months long. During that period, you can see the VIX lived up in the 20s the entire time. So we came back down. We had in April, it looks like we moved down below 20 very, very briefly. Same thing in August. But it wasn't until later in November that we, went down and started spending much, much more time below that 20 area. So the key takeaway here is when you have a very volatile market that normally coincides with market weakness, and when that VIX is in the 20s, normally what I do is I start looking for bottoms based on spiking equity only put call ratios. When that 5-day reading, and this is marked by the green line coming across here, the thick green horizontal line, that's 0.75. When we move above that level, that is generally telling us that the market is extremely fearful. And that is normally when I would look for reversals. So what I've done is when we've reached peaks in this 5-day reading, I've shown you these green vertical dotted lines, these green dotted vertical lines. And look at when they happen to come in. When you get above 0.75, that's when you should start looking for a market bottom. Temporarily, probably. Could be permanent, but probably temporary. Here you can see back in 2022, it marked the bottom least, and I'm talking short-term bottoms here. We just, for a trade, I'm just looking for a bounce. These are going to be areas where I think it starts to get a little bit safer. The only problem is a lot of times when the fear is picking up, you get the VIX going up. If you miss the bottom by a day or two, it can really start, it could be painful. So, there's a downside to trading anytime the volatility index is high, but this is at least a method to try and to signal to you that, hey, maybe things are getting a little bit overdone to the downside. Most of these green dotted vertical lines that you see on the screen tie in almost perfectly to short-term bottoms. The red dotted vertical lines are more aligned with tops. That's when the equity-only put-call ratio moves down and shows a lot more preference by retail traders moving into calls. So they're much more bullish, and they get too bullish. But this green line is the one we're waiting for now. Because volatility is elevated, we've got more fear coming into the market. What we want to see is this 5-day moving average get up to about 0.75. Now, as of yesterday's close, we're at 0.73, so we're getting close, and we are getting a bounce off this bottom so far. But can we make a sustained move up through that 0.75 area? So we're not quite there, something at least to keep in mind. Now, once we get past, any fear that's been building because of, the economy and what they've been talking about, keep in mind the election year is this year, presidential election. I've gone back and I've done an annual kind of average forecast based on all the prior presidential elections since 1952. And so I think there were 18 of them. And I took averages and I used the user-defined index at Stockcharts to come up with this chart of kind of how these years play out. And you can see we make pretty good runs up until about mid-August, and then we start running into problems. Now, this time we got up into late July, and that seems to be when we started running into problems. So maybe it's a little early this year. But by the time you move into September and October, that is historically the worst time of the year when you're in a presidential election year, which we are in. So even if the economy strengthens or, becomes or isn't as much of a problem as maybe some of us think that it could be or could become, keep in mind right here, we've got this red shaded area marking a very difficult period as we get closer and closer to the presidential election. Good news, though, right before the election and through year end, we tend to see the market go up very significantly. So let's keep all of that in mind. On Monday night, I had an event. It was basically it was just based on all the fear that was building. So we've seen a lot of selling and the fear's been rising. So the big question I was getting from a lot of members is it a bounce or is this possibly going to be a crash? And I had so many questions, we decided to host an impromptu event. So we did a webinar on Monday at 4:30, just after the market closed. You have an opportunity on your screen if you're interested to go back and take a look at that recording. It's all it requires is a free 30-day trial to our service. No long-term commitments, nothing like that. Just try our service for 30 days and we'll give you this video to check out. But on your screen, on your mobile device, just simply go to that QR code and it'll take you to the landing page and get more information there. All right, a couple more things I want to go over before we wrap this thing up. Technology. Technology is a big driver of the S&P 500, currently around 32%, maybe a little bit less than that now, but that's a big number, a big percentage. When the XLK technology is not doing well, it really puts a lot of pressure on the S&P 500. Well, if you look since early in, or maybe mid-July, we topped. We've seen the technology group coming down, and obviously that's putting a lot of pressure on the S&P 500. But what most people maybe haven't seen looking at the chart is notice that these lows on the XLK have been rising. You can see that blue directional arrow pointing to these lows and show it's just pointing out they've been going up. However, relative to the S&P 500, look down below. These relative lows have actually been going lower. So yes, technology has moved higher in terms of absolute price action, but money is actually rotating away from technology in this process. So I don't know if this is a precursor that we're going to have a bigger drop, or if it's just a precursor that, hey, technology, you've had your run, and now we're going to go take a look at some of the other areas of the market that may do better. Next chart I wanted to show you, XLY. I think we're at a very critical point on the XLY chart. So this again is a 5-year weekly chart. You can see back in 2022, we had a rally, couldn't get through the 170 area, went a little bit above in July of 2023, came back up again in September 2023, couldn't get through, and then finally came back up in November, December, when we had a pretty good rally last year. We were able to get through that 170 level, and we've tested it a few different times. And at the beginning of the week, we went below it and came back up. My point here is, if we go back down below that low that we saw on Monday, this is really starting to point to perhaps the next support level down just below 150. So just keep that in mind, because we're talking about perhaps another 12% or so to the downside, something to watch for if we do see the market start to roll over again. Communication services, negative divergence. We haven't gone down to the 50. And I just want to point out this channel. If you connect the highs over the last almost 2 years, drag that line down to the lows that printed back at the end of 2022, this channel could be tested at some point, and notice that it's coming in right at that April low. It's coming up underneath right where we were in April. So another chart to watch, the XLC. If it gets back down to around 76, maybe something like that, we want to see this hold 75, 76 range. If it doesn't, that's giving us maybe a hint that we have more weakness ahead. Growth versus value. I think this is a really important one to keep an eye on. Notice that when we topped in the market, or maybe actually it was a little bit before we topped in the overall market, this ratio topped. Money started rotating away from growth before we hit our final high on the S&P 500. And as the market's been going down, so too has this ratio. So, and that's kind of normal, except this week we're trying to bounce. And I'm seeing that IWF, IWD ratio moving lower this week, even during the recovery period. So that doesn't bode well. So far, it is holding this trend line. It's a relative trend line. I think if we bounce off of that and start rolling back up, we still have a chance to just kind of, keep this to being nothing more than just a little bit of a pullback, and then possibly bounce back, maybe go back to all-time highs. I have my doubts a little bit, and I talked more about that in that video I just mentioned. But this is going to be a key too. If we see growth stocks fall apart and lose this trend line, it's going to be much, much more difficult for the S&P to make any headway to the upside. All right, S&P, well, this is the Dow Jones US Semiconductor Index. I just want to point out that in April, when we bounced, here was the bounce on semiconductors, here was the bounce on the relative strength of semiconductors, and here was the bounce on the S&P 500. Now, if you go to what we're doing right now, you can clearly see that we have a bounce in the S&P 500 off the low. Not so much in the relative strength on semiconductors. Yes, we are getting a little bit of a bounce back here, but we're no better off now than we were when we hit the low. We're actually down a little bit from where we were at the low. And then notice these candles on the way back up. We have one really solid hollow candle, but we also have one really solid filled candle. The one candle in here is a doji, so we opened and closed at the same level. And I don't know where we're going to close today. This last candle, we're showing a little bit of a hollow candle, but it's not over. I don't know where we finish. We've been very volatile, so I'm not going to try and make any predictions until we see that, see where we are at the closing bell today. As I mentioned before, though, there are other areas in the market. And we've been kind of trained over these past few years that it's all about the Mag 7. It's all about technology, maybe communication services. You got internet, you got your semiconductor, you got software, computer hardware. Maybe in the discretionary area, throw in, the autos. We've had some pops along the way with Tesla, Amazon, and so forth. So you've got some, those have been the key areas to watch. But right now, those are the areas that remain under the most pressure. So I think you got to look in other areas. Last 2 weeks, I've given 3 industry groups, the same 3. And I want to show you where they are today. So biotechs did make the move up to this 3,100 level, have pulled back, but they're still near the high. A breakout above 3,100 would be very, very bullish for the biotech area. Next up, how about defense? Defense stocks, look across here. We had a double top no more. Look at this move. What moved to the downside? Defense stocks just keep rising to the upside. So another area, it's not bearish everywhere. So if you want to participate in the market, just be careful with those growth stocks until they start to show more relative strength and can break out above some key levels, maybe the 20, day moving average down the road, or even, making sure we get a confirmed close back above the 20-week EMA. But we've got to see a little bit more strength and growth before we want to commit too much to it. Look to other areas. Again, biotechs, defense, and I'm just bringing up a few of them. There's plenty of them out there. How about aerospace? We made the breakout, got up to a little over 2,100. We pulled back and we've tested that 20-day moving average and, 20-week moving average. And now we're starting to bounce off of it. So this is not a bad area to catch some of those aerospace stocks. So it's not all about the Mag 7. These are some other areas definitely to keep in mind. All right, I'm going to go ahead and wrap up. If you would like to try and follow me at EarningsBeats, I'd love to have you. Up on your screen, you got a slide again with a QR code. If you use your mobile device and scan that QR code, you can follow me. We got a number of different ways you can follow me around, with my articles, of course, my YouTube videos, and so forth. Also, how you can reach me at EarningsBeats.com. So please make sure you check that out. And then, I really feel like right now we're just kind of in the middle. We're in this tug of war. Today we got good news. Initial jobless claims came out much lower than expected. So we've been talking about jobs weakening, which they have. Unemployment rates gone up. Initial jobless claims have been rising. Today we got a little bit of good news, and you see the market responding the way you would probably expect with good news on the jobs front. But I will say initial jobless claims are quite volatile from week to week. So this is something that I would continue to pay attention to over the next couple months. But if the Fed doesn't lower, and especially if they don't lower in September, I think the market could have a very, very difficult period ahead. So just kind of follow me. I'll keep you hopefully ahead of the curve, and we'll watch it together. Have a great day, everybody. Happy trading.